Are you looking at getting into Forex trading? Don't start before watching this video. This is Forex Trading 101, the basics you need to know before you start currency trading. Hi, my name is Ian Coleman and I'm a senior analyst at FXStreet. Today we're going to break down the core basics of currency trading by answering a few simple but essential questions. What is a currency? A currency is the country's official money and it's used to buy goods and services. For example, USD is the United States dollar, GBP is the Great British Pound, and JPY is the Japanese yen. What is a currency pair? In Forex, currencies are traded in pairs, also known as crosses. A currency pair shows the value of one currency against the other. For example, sterling against the US dollar tells us how many US dollars it takes to buy one British pound. The first currency is called the base currency. The second currency is called the counter currency. What is foreign exchange? Foreign exchange, or Forex, is the simple process of swapping one currency for another currency at an agreed exchange rate. When you trade Forex, you're buying one currency and selling the other currency at the same time. What is a pip? A pip is what we trade. It's the smallest price movement in Forex markets. For most currency pairs, one pip equals 0.0001 or 4 decimal points. For Japanese yen pairs, one pip equals 0.01 or 2 decimal points. Profits and losses in Forex are measured in pips. What is fundamental analysis? Fundamentals are the economic forces that move price. This includes interest rates, inflation, jobs data, central bank decisions, risk on, risk off sentiment, and geopolitical news. News moves markets. In currency trading, economic developments that tend to lead to more restrictive monetary policy by the local central bank will usually benefit the local currency relative to its counterpart. What is technical analysis? Technical analysis, on the other hand, focuses on price charts. It involves identifying trends, patterns, and key levels using tools like support and resistance, indicators, candlestick patterns. The goal is to anticipate future price movement. What is leverage? Leverage allows you to control a large position with a small amount of capital. For example, with 30-to-1 leverage, $1,000 controls $30,000 in the market. Leverage magnifies profits, but it also magnifies losses, which is why risk management is crucial. What is a lot size? A lot is the size of your trade. In Forex trading, a standard lot is 100,000 units, a mini lot is 10,000 units, and a micro lot is 1,000 units. In most major pairs, one standard lot roughly moves $10 per pip. What is the spread? The spread is the difference between the buy price and the sell price. This is essentially the broker's cost for executing your trade, and it's paid when you enter the position. What does long and short mean? Going long means you buy, you're expecting the price to rise. Going short means that you sell and you're expecting the price to fall. In Forex, you can profit in both rising and falling markets if you're able to identify the next move of a currency pair. Are you starting to trade Forex? Subscribe to our channel for more educational videos.